Hello, hello, hello. Let's get this show on the road. Just getting my video stuff all set up, and I'll fill you guys in on what's happening for the day. Send out the notifications. And how is everyone doing today? We're just a couple of minutes here before the weekly market open. How is everyone feeling? What's everyone looking at? And pretty shortly, we'll be getting into a written notes, some written outlook notes by yours truly. So, everybody who's here so far, welcome to the Plan the Profit Daily Plan, right? I'm your boss, Joe Boss. And the highlight for this next week is FOMC, right? Now, it's been super mixed when it comes down to expectations for this next FOMC. And I want to bring up a few points that are leaning towards the more hawkish interpretations, because I think those are more likely to get realized than the market is currently pricing in. And that simply comes down to inflation being stickier than it otherwise should be. Simply put, let's head on right into the markets. Now, two, two, two. So here on the screen, you can see I have the DXY chart. I got my little view cam, and I have this thing on the right hand side with a bunch of notes on it. This is an app called Obsidian, and I've been using it to keep track of all my outlooks just for this week. This is all the research I've done just for this week, covering institutions. Look at all these guys here. So these are all individual notes of individual complete outlooks just for myself, right? And I've gone through, read through all those outlooks, took my notes on each outlook, and I summarized the most important things into this one document here. So this is a whole review. This isn't going to be a whole macro steering, right? We're here to trade the day and have some trading expectations for the day ahead of us, the first trading day of the week. But it's good to know what were the trading expectations from the outlooks coming out starting on Thursday last week, Friday, and Saturday. Those are the main days that these outlooks come out. What were some of the highlights of the outlooks that were released, and who had those expectations, who was writing those outlooks? I'm a huge proponent of writing outlooks, of reading outlooks. The more outlooks you read as someone who's new to trading, the more exposure you'll have to how different traders have different market expectations. And as you read more and more outlooks, you'll run into people who make insanely great, concrete stories and themes. And over time, as you read more and more relatively pretty smart people take cracks at writing outlooks, you'll kind of sop that up. At least that's my hope. That you'll be able to think more critically about the trade plans that you're fed through just from some pundit you saw on some Zero Hedge article or from some random trading view plan. Don't get me wrong, there are plenty of people who use those outlets to write excellent outlooks. But you have to understand that most outlooks are pretty mediocre. But you're not going to be able to learn which outlooks are mediocre or great or insanely insightful for your skill level until you actually start consistently reading outlooks when they come out every week. For the week ahead, for the month ahead, for the quarter ahead, for the year ahead. If you understand future trading expectations and the different expectations that other traders have, you'll not only be able to relate better with other traders, but you'll be able to have a better idea of what your own expectations should be once you start reading new information that those outlooks may not be taking into account. And that's really where you can, we just got our daily update. We're now here on the DXY where we've updated. And we can make our trade plan for the day, finally. Yay! Alrighty. Money bags in the chat. Yeah, the Plan the Profit logo is a money bag. I think that's quite appropriate, right? I think that's pretty appropriate. You want to plan to get the bag. Plan to get that money bag. Plan to get that money bag. Okay. Enough about the lectures and, the boss gospel of why you should read your outlooks. It's like, why should you eat your vegetables, right? Read your outlooks. I'm sure you guys have had enough time just to see what's already been here on the chart, so I won't bore you looking at just the Forex section here, right? You can see how things are pretty mixed on Euro. There are some more bearish expectations for Euro going forward, right? And then for dollar, it's still a bit mixed, where in the immediate short term, like you could say 2 to 3 months out, there's still some people saying dollar might still be getting a bit strong, but then they have longer term expectations out into potentially 24 about dollar getting weak. But just about everyone has those expectations when you finally think that a recession is going to be definitely out of the question by that point in time. So let's move on to the highlight. And you'll see that I have a little section here, Joe's hawkish FOMC speculations. We'll get into that. And we're not going to be even reading all this text here. Right? These are literally the highlights from these outlooks. So if I click on this outlook, this is Seb's big week with the Fed, ECB, US dollar inflation outlook that I've taken highlights of and quoted. And then you can see this is the chart that they have in that outlook for their future rate expectations for the Federal Reserve and their future rate expectations for the ECB. The Fed's in red, the ECB's in blue there. And then I can go back to these outlooks and I can check all the other outlooks that I've been reading through. Or I can just read this one little sentence here and get the main point out. So you guys can read through that. But the summary of it is that, there's a lot of choppiness in the sentiment between outlook to outlook on how certain people are that the Fed will actually be hawkish or dovish. Most people, I think every single outlook, agreed that the likelihood of a skip is probably the consensus viewpoint that the Fed would skip in June here and then hike in July. That's not only the consensus view from the analysts. The analysts are deriving that from market pricing of rate futures contracts on CME. So with that in mind, also understand that the next thing, and not many outlooks actually discuss this, that could move those probabilities, right? You want to think ahead of what could then change your trading expectations, right? Being reactive and nimble to new information as it comes in. The thing that could change those probabilities from the stable consensus of, oh, the Fed will skip this next week on the 14th, and then they'll hike in July. The thing that could cause that consensus view to shift more hawkish, whether that's the skip will have more hawkish forward guidance behind it in the speech, or whether it'll just straight up be a 25 basis point hike. And my personal view is that it's split 50-50 between those two options right now. The thing that will kind of set in stone whether or not that occurs is how not the headline CPI comes out, but how the core CPI came out. And I'm so glad I watched Mark Meldrum's Outlook before coming on and going live right now, because literally no one else that I had read of all these other outlooks mentioned how core CPI, the release specifically of core CPI, could make, if it's sticky or if it comes in flat, if that's the thing that could make the Fed go more hawkish or not. Most of the time, these outlooks are just mentioning, oh, if inflation, we're anticipating headline inflation to come down a bit, and if it comes down a lot, we expect the Fed to be dovish, and if it comes in flat to just a little bit down, we expect the Fed to still be a bit hawkish, but we still are anticipating a skip. I think that the Fed's not going to be looking at headline. I think the Fed is going to be looking at core, because part of the problem with the way the Fed is interpreting inflation right now is mostly down to services. Now, there's a bit of a unique risk, you could say, profile that I think I don't have as quantified. But now let me go into my speculations list here. And I know this list looks kind of long, but I'm just going to summarize this too real quick. And trust me, we'll be getting into the trade plans here on the DXY. And I'm pretty sure you guys who've already been looking at this chart for a while and know how I use the range probabilities already know exactly what to do. As soon as you saw this chart, you already knew exactly what price ranges to target and exactly where on the distributions you want your thresholds for your stop losses and your take profits. Having visual aids like that with these sorts of statistics are just such a great help, especially from day trading where there can be quite a lot of noise to weekly swings and monthly swings. That's the great part. This works on every higher time frame, and it gives a bit of extra statistical significance to targeting certain pivot points, which is great if you're incorporating pivot points as like threshold levels, which is interesting. So let me go over these speculations that I have of why the Fed actually is more likely to come out more hawkish than I think most people are anticipating. And I could just go down this list, but I last left off talking about services. So I'm just going to go straight to this section that talks about services. Most of the inflation that we have right now is coming from a small sector of the economy that's the service part, and that's generating most of the inflation. And I think the Fed will want to hike in order to really try and kick down services. So I have this little idea right here. I don't know how valid it is econometrically, or I really should be talking to maybe an economist who can pull up these numbers from an icon or a Bloomberg terminal and help me do this sort of research. But I'm just throwing an idea out there. So I'll read this verbatim. A rate hike from the Fed would increase financing costs for service companies. And a lot of service companies are having to just borrow and borrow and borrow a lot of money just to stay afloat. And now borrowing that money is coming at the cost of having to pay a higher interest. So now companies are having a harder time borrowing that money. And the only way that they'll be able to borrow that money or be even offered loans is here. Service businesses will need to price more competitively in order to generate the revenue needed for that stricter financing. So if the Fed does a 25 basis point rate hike, on top of this, I think it's just going to accelerate this particular process of, okay, we're going to have to get more competitive to effectively steal business away from our competitors. So then we can stay in business because the amount of business that's out there, while you can certainly grow your business into areas where you're not competing with other people, if it's between you and the other guy staying in business by a year from now, you're going to try and poach their clients. That's that that's just how things work in the world, especially when there's only a handful of clients or you're working in a regional location, if your service is a regional location. Now, here's one more thought. If the Fed does hike, it'll keep commodity prices lower. And commodity prices recently, if you've read some commodity outlooks, you would know that the outlook for commodities is actually quite bullish. So if the Fed does skip or pause straight up, it'll give some lift to commodities. And that lift in commodities could then bump up the headline number quite significantly because movements in commodities right now are still quite volatile. So you could see oil go up $15, $20 over the next month and then cause CPI to go up maybe 0.2, 0.3% month over month. Because it wouldn't just be oil, it'd be the entire commodity complex that would be going higher. So that's one more reason I think the Fed will stay on the hawkish side of things. Also, if they did the 25 rate hike and it did send oil lower, it would kind of hurt OPEC and their cohesiveness because it'll disgruntle the people who agreed to take production cuts out into the future, where now oil is really, really low and they really, really need to pick up production now to generate revenue, to get some money. And the US is just kicking them while they're down. So don't get me wrong, there's a lot of things. There's also this whole T-bill thing. This could end up being quite a hawkish move. I wrote up my thoughts on it. And then there was this massive thread posted in the last 24 hours by Conda. And he also anticipates that this is going to lead to a more hawkish Fed. And don't get me wrong, if you guys don't know who he is, it's all well and good. But he's got like 100,000 followers on Twitter, and he's just done this impressive analysis on the whole T-bill refill, the Treasury General account refill, as he says right here. All right, and this is some Wells Fargo outlook. ECB, effectively, everyone's anticipating 25 at this meeting, 25 at the next meeting. However, I anticipate that if the Fed actually does hike here in the next week, we get an actual hike, not a skip and not a pause, that we could anticipate that the ECB will do a third 25. That future rate hike path of the ECB will have to go a bit higher. One more thing, Bank of Japan. We got some Bank of Japan information. Hello, kitty cat. She's making quite a lot of noise. You want to come over here? Kitty cat needs need some attention too, guys. I can't just be giving all my attention and all my effort to you. I got a little kitty cat to take care of, but she's not coming over here, so I can't put her in front of the camera quite. Well, I'm certain you can hear her. She's quite a chatty cat. She's the chats. Anyways, thank you guys for listening so far. I know I'm just saying, oh, read my notes, read my notes. But I'm trying to summarize them quickly enough so that then I can get to doing some, 3 or 4 trade plan charts while still cohesively covering some of the major things in this outlook, right? Now, these notes are just for me. I'm not distributing them. There is a way I can distribute them, but I'm not gonna right now. Simply put, this is just for me. It's like a data bank for my head. So then, as I do more writing and organizing of my thoughts with these outlooks, I'm able to give more cohesive breakdowns of future expectations for you guys here on the show. And let me know what you guys think about this. And tell me about it in the Discord as well. Link to that's down in the description. It's the very first link. So if you want access to these outlooks, which are totally free, by the way, these outlooks are completely free. Just join the Discord below, and you'll be able to find the outlooks channel, and in there, all these things are listed. So yeah, as far as the Bank of Japan goes, just glancing through this, expectations for further yield curve control, YCC, are anticipated. Some are anticipating that maybe they'll do it at this next meeting, but it's really going to be dependent on what the Fed does. So back here, when I mentioned Japan and my FOMC speculations, if the FOMC does hike, that could help the Bank of Japan reach conditions to adjust their yield curve control at a sooner date. So that means they could, if the FOMC actually did 25, argue, okay, things are getting tight around the world, and the dollar yen exchange rate is going to weaken in very significantly if we don't make some sort of hawkish stance here. And right now, a lot of traders, when it comes down to yen and Bank of Japan and Nikkei, I mean, Berkshire Hathaway is looking at this, right? You absolutely know Berkshire is looking at this because they're trading the Nikkei, right? They got their money in the Japanese trading firms. Right now, Japanese 10-year bond, it's getting close to the edge of where the Bank of Japan would step in and buy rates. They don't like this higher low, right? From a technical standpoint, they want to see yields continue to drop and drop and drop. Or rather, just at least go sideways and have some sort of lower drift. And I think that at some point, I believe one expectation I read was sometime in October, you'll actually get the Bank of Japan to update their policy. But man, the Bank of Japan is getting pressured politically quite hard because people in Japan really do not want to see a dollar yen exchange rate that's like at 145 again. That's just really gonna be too much. Bank of Japan's gonna have to step in sometime in the next like 500 pips or so, right? As much as they'd like to keep their stock market going, up into the clouds, right? Let's see here. There's some expectations that the RBA will do another 25 basis point rate hike in July. Actually, quite a few outlooks anticipate a rate hike in July out of the RBA. Same thing, actually, with the Bank of Canada. There's more of a consensus on another rate hike in July of 25 basis points for the Bank of Canada. This is some stuff about China slowing down. China is seeing actually still quite a considerable slowdown. And actually, a lot of the concerns about China slowing down have been coming out of analysts from New Zealand, believe it or not. So I think if China does get weaker, that the better play would be to actually short New Zealand instead of maybe Australia, because there's just so much more negative sentiment around China's economic slowdown in New Zealand than I'm seeing out of Australia. So I think Australia would be able to bear the brunt of any Chinese economic weakness better than New Zealand, which is a new insight that I've got. And then recession jinx, more institutions are now saying, hey, we could be getting a recession, even though now most people are not anticipating a recession now. Or people are split effectively 50-50 whether or not one's going to actually occur or not. I'm still in the camp that it's most likely going to occur, and so I'll continue to anticipate it and not get jinxed by it. And then you can actually see right here why core inflation seems like a big, big problem. So this chart here on the left-hand side, if I make this super big, let's see here. If I could real quick. All right. So see here on this left-hand side, this is headline US inflation. And you can see how it's coming down. So most of the analysts and most of the expectations in these outlooks are based off the headline inflation coming down and the Fed reacting based off this headline inflation to do a skip or to pause. And you could say that's on the neutral to dovish side of Fed expectations. But the Fed already came out and said that they're still concerned about inflation. And then if you go and you read also some of the central bank speeches from the surprise rate hikes that we've had recently from the Bank of Canada and the Bank of Australia, they explicitly mentioned core inflation. They explicitly mentioned it. The UK core inflation is reaching new all-time highs. Core inflation is the sticky part of inflation that is going to be the new focus, right? Now, some people are going to say that this is kind of like moving the goalpost, like, oh, headline inflation used to be what these hawks cared about. Now they care about core inflation. Well, the truth is that it's just one leads the other. Headline inflation is coming down, which means that's moving in the right direction. But now, another very important macroeconomic indicator of inflation isn't coming down and still at very high levels. And this could warrant more rate hikes out of all these countries in order to actually establish all these central banks hitting their inflation targets in, the year and a half that they all forecast perpetually that they'll hit it by. So you can clearly see, just looking at that chart, that's just a big mess. And let me move this back over there. And I think I'm pretty much done. Oh, yeah, and then George Soros handed over his billions of dollars to his son, Alex. And Alex, geopolitically, this is important because Alex said this. He was concerned about the prospects of Donald Trump's return to the White House, suggesting a significant financial role for the Soros organization in the 2024 presidential race. Quote, as much as I would love to get money out of politics, as long as the other side is doing it, we will have to do it too, he said in an interview at the fund manager's New York offices. So, yeah, Soros' money is going to get more mobilized in U.S. politics coming over the next year. So, do not be surprised if you see more targeted ads. And I still wonder who they're going to run. I wonder if they're going to run Joe. Who, most people in the world who have a brain don't want Joe to run again. Alrighty. So now we are done. We are done with the Outlook review part. So thank you all for sticking around and watching that. Now let's get into the charts. Let's look at trade plans for the day ahead. And we can start with the dollar index. So if you're a bear and you're anticipating to get a short sometime today, you ideally will get your short somewhere around, call it 103.58, or this R 0.5 pivot. And if I zoom in here, you can see 103.58 is right here at this R 0.5 pivot point. And this is an indicator I built called Wayne's Pivots. Now, what's interesting, and I promised someone who actually bought this indicator today that I'd cover it in the stream, are these pivot condition icons. And this is something unique that's only in this indicator that helps you see just by looking at this icon without having to scrunch your chart like this and zoom out and look at the full set of pivots and think super hard about it. The indicator indicates, right? The indicator indicates. So what does this mean, these little icons? When you see the tooltip here, compressed means that the volatility from the prior trading day is so small that this set of pivots, the current trading day's pivots, are completely encompassed by the prior trading day's pivots. And this gives you a much tighter trading range for the next day ahead. So you have generally two assumptions you can make. You can either A, have a trading expectation that volatility will continue to stay low, and that's a reasonable assumption going into the economic events ahead, because going into economic events like CPI or FOMC that have a lot of uncertainty behind them, markets tend not to move a whole lot, or they can. It can get quite unpredictable when there's a lot of uncertainty in sentiment, because you don't know if someone gets a little bit of extra information and it skews their bias, and suddenly they have a bit of informational advantage against the rest of the market, and suddenly they're moving billions of dollars, pushing the market in one direction. And then you find out 5 minutes later, after they put on their position, because it's now come down financial juice, oh man, some big piece of news just happened and the price has already moved 50 to 100 pips. Great. Sometimes in those situations, there's just nothing you can do. However, when looking at these pivots, there's at least some strategy you can formulate. So with these compressed pivots, if you have the assumption that those sorts of events won't occur, that we're going to have relatively the same volatility as yesterday, then you can make an assumption that we will most likely stay between this R1 and S1 pivot point. So when you have a compressed pivot and you anticipate volatility to stay the same or to continue to decrease, then price generally should stay between R1 and S1 going into the end of the day. Now, if let's say these pivots are compressed, but you're anticipating those big 50, 100 pip moves, like I just said. Well, in that case, you're anticipating a volatile move in the day ahead with pivots that are in a super, super tight range now, which means, if the volatility is about to expand, but the pivots are based off of volatility that's contracting, right? That's what compressed pivots mean. Then once you go past, then you should anticipate going past the R1 or S1 pivot. At that point, you should anticipate if, when you have compressed pivots and you anticipate volatility to increase, that you will go past the R1 and S1 pivot point. And that's it. Those are the only two little assumptions with this. And then there's another version of this, expanded pivots, right, with this little boom icon here. We actually got two expanded pivots in a row back here. And this is the opposite of compressed pivots. That cat. Hello. I was a little girl. You want to keep bugging the stream? Who's a good girl? Who is a good kitty cat? Yeah. The other star of the show. That was nice. Okay. So just a quick explainer on these expanded pivot conditions. If you have expanded pivots, it means you need the heightened volatility to stay at elevated levels from the prior trading day, or you need volatility to increase in order to go past this S1 or R1 pivot. If you're anticipating volatility to start decreasing going into an expanded pivot, then it's reasonable to assume most of the time that you will stay between this S1 and R1 pivot. Exactly the same idea as the compressed, just with the assumptions and expectations we have reversed. And I'll be covering that more and more often as I do more of these streams. But right off the bat, those are two useful things that will work on this indicator for the daily, the weekly, the monthly, quarterly, every single time frame resolution pivot. Those assumptions generally apply. All right, let's move on to maybe the ES. How did the ES come in today? Are we even, the ES isn't even trading right now. Neither are the commodities. Bitcoin is not up a whole lot. Litecoin's up a whole percent. That's interesting. Probably because it took a particularly hard beating. I mean, Bitcoin, it didn't fall as much as Litecoin did. That fell 15%. Bitcoin fell about 4%. And I think, if I'm not mistaken, this is a long trade, or that's a threshold. Oh, yes, no, that's a threshold for that particular trading day. Yep, that was when I was doing a one-on-one, showing someone how to use range probabilities. If you want access to all these indicators, by the way, the link to that's in the description. It's on the Boss Benchmarks WAP store. And it comes with access to me directly, one-on-ones, right? A trading group, a chat where I'm posting all my trades and all my analysis, and then a whole forum of trade plans just for the trading group, plus access to all of the indicators. You get all of that with a subscription for $100 a month, which is very, very competitive pricing compared to what most people are doing. And that pricing is not going to stay around forever, but I'm going to try and keep it around like that. But at some point, I hope to hire one or two helping hands, maybe with programming new features, programming new indicators, and running the trade group. Right? We'll see. We'll see how successful and how many signups I get doing these streams. But the more you guys can share and the more you guys can help promote this, the more I can do for you. And some free stuff will definitely be a coming. Some free indicators, hopefully in the future. Some things you can look forward to. Let's get into this particular chart because I'm actually trading this right now. So in my last stream on Friday, I announced that I got out of my dollar CAD short from all the way up here, all the way up there, for 196 or 194 pips. I think it was 196 pips that I made. I did pretty fantastic on that. All because I anticipated the Bank of Canada would hike when no one else was going to hike. And I also anticipated that the Bank of Australia, the Reserve Bank of Australia, was going to hike. And no one thought that they would going to hike. And now people are flipping 50-50 because all the people who were calling for the Bank of Canada and the Reserve Bank of Australia to hike are also now anticipating a more hawkish Fed, and that's got people who would be dovish otherwise a bit on edge. That's what happens when you have just a chain. You just have your set of expectations, and your expectations match with reality. Suddenly people start coming to you and saying, well, what do you think about what's going to happen next? Right? What's going to happen next? And hopefully I'm going to be that place for you. Right? Hopefully I'm going to be that place for you where you can also learn how to do it for yourself. When it comes down to this trade, we were at a low. And I'll go ahead and use the replay function because this indicator works with the replay. And I'll go and replay up to the bar I entered on, which is this one. And this is on the Friday. So I got in right around here. Now, do you guys think just by looking at this distribution of where most of the lows for a given trading day occur, just by looking at this distribution here, does this make sense, right? Does this make sense to you that buying at this area makes sense? Well, get this. If I go and I hover over these labels, each of these labels tells you the probability of getting the low for a given trading day between any two prices. Now, this orange area here, called a bin, highlights where the low actually occurred or where it currently is. And if I hover my mouse over the label where it's highlighted orange, I can actually see the total number of probabilities that occur, the total percent odds of times the low for a given trading day occurs above this price, and the number of times a low occurs below this price. And this isn't an empirical set of data points. This is an actual probability distribution. And it's not a probability distribution that's easy to program, to say the least. But it is what Harry Markowitz has said, the guy who created portfolio theory, that Harry Markowitz. The math I'm using for this, Harry Markowitz said that if what it promises is true, that it's going to be the single most important improvement and development in statistics over the last 100 years. That's that's the kind of math that we're dealing with on this indicator. And it can help pick out a low and help you pick out thresholds. Because when I went long here, I'm like, oh, either the low is going to come in right around here. My interpretation was that. Or I need to put my stop loss right here at effectively right at 133 as a threshold level. Because once we go past 133, I don't want to have to deal with the likelihood of, for example, one of the reasons why we bounced and one of the reasons why we got out, and this was live stream, yet on my last stream, I got out because I saw that the Canadian unemployment numbers came in poorly. They came in really poorly. So I took that as an opportunity to get out. I also saw the yield spreads. Oh, the yield spreads. The yield spreads were also strengthening in favor of the US dollar. Don't get me started on the forecasting power of yield spreads. But yeah, the yield spreads helped a lot with determining to get out. Same thing with this. A lot of things lined up, but they weren't your normal TA. It was the flow of bonds moving in favor. Yields were moving in favor of the US dollar. So billions and billions of dollars were reversing and going the other direction in favor of long Canadian, of dollar Canadian. And we were at the likely low for the day based off statistical distributions. And don't get me wrong, if you were waiting for that macroeconomic event of Canadian unemployment and to see it come in so poorly, maybe if you understood how to read that, you would have said, oh, wow, that's probably a good time to get out, or maybe a good time to get in. It's probably a riskier decision to use that as your entry signal for a long, to be frank, standalone, right? Just that one macroeconomic indicator. But as an exit, it's actually quite fair. But then when you take it into account with all these other indicators, specifically a probability distribution and yield spreads, things tend to work out more frequently than not. And this is, don't get me wrong, this is all still discretionary. I could make a mistake in executing these trades. But now I've been doing this for 4 years. This is like back of my hand sort of stuff. You know how long it took me to do my trade plan for the entire week and technically into the end of the month for June? So I've already done my trade plan with these indicators on what prices I should be anticipating to buy or sell at or get stopped out at for every single US dollar pair, for every single JPY pair, for every single crypto I'm interested in trading, for every single commodity I'm trading, and for TLT and a couple of yields that I'm looking at. That's all the major asset classes. You have equities, crypto, bonds, commodities, and currencies. Those are all the major asset classes, effectively. I mean, maybe you can throw real estate in there or something, but some would argue that kind of falls under commodity, but whatever. I think it's its own thing. But it took me 45 minutes to do all those trade plans. 45 minutes for the entire week, and for some, the entire month. 45 minutes for all that stuff. If I wasn't doing these streams for you guys and doing all this extra trade research, writing it down to make sure it's presentable for you here on the stream, and writing things down to help you guys understand how to read outlooks so that then you don't get caught up on anything, so that then you can learn and become more competent about the markets that you're trading, and then doing that over and over and over again, just learning and learning and learning as much as you can about markets. If I wasn't doing all this extra stuff with this community, I would only be spending about an hour and 30 minutes a week in front of charts. An hour and 30 minutes at most, maybe 2 hours at most, like on a busy week, maybe 2 hours. You spend, when you have a proper strategy and you actually understand what you're doing, you already have some baseline expectations of what should happen. And then you will end up spending more and more of your time doing trade research instead of looking at charts. Because a lot of the information that you need to actually become competent at trading does not come from the charts. It comes from other traders and outlooks and learning about economics of the things that you're trading. Even when it comes down to cryptos, especially NFTs, you want to be picking assets and you want to be picking projects that have reputable people behind them, people with good track records, projects that actually have some merit behind them. And then the same thing with currencies. You want to be behind a country that has momentum. And then the same thing with commodities. You want to be in a commodities environment where people are willing to spend more, where growth is expected to rise. And then et cetera, effectively also for equities. Although if you're a good stock picker, you can find an equity for any single trading regime in the whole growth inflation matrix. And don't get me started about talking about growth inflation matrices now. I just found a whole nother one on growth inflation matrices. I posted, if you want to know what I mean by growth inflation matrix, join the Plan to Profit Discord. It's the first link in the description. And check out the fundamental EDU under the resources at the very bottom of the Discord. And just search growth inflation matrix. And you can learn so much. If I were ever to make a course on where to start when it comes down to building your knowledge and competence in trading, the first thing I would want people to see when it comes down to trading applications is the big picture first, right? And the easiest thing to understand big picture trading, the whole macro view when it comes down to any asset class, the regime you're trading, how to understand what regime you're trading in, comes down to these growth inflation matrices. And billions and billions, I'm doing a Trump here, billions and billions of dollars are being traded on through growth inflation matrices. It is absolutely worth your time, if you don't know what a growth inflation matrix is, to join the Discord, and to join the Plan to Profit Discord, go to the resources section at the very bottom, and find the fundamental channel. And then just search growth inflation matrix. Check out the stuff in there. I'm constantly posting stuff in all the channels. I'd love to have some company. Come share some of your own things. Come share some of your own thoughts and some of your own traits and some of your own analysis. And don't be concerned if it's using my tools or not. I just want people to hang out with, because it's like 80% me posting. So anytime you get some free time, whether that's just to ask me what's going on, or to post your own thoughts, or if you're curious about something, come to Plan to Profit, post around, and try and grow with the community. All right. So hopefully this is visually clear why I would buy right here. This is a buy. You could say this is technically a bimodal distribution. You got a peak where most of your lows occur right around here. You could say if you have particularly bullish trading days, right, your low is going to be very close to the open of the day. So here's your open of the day, right around here. And so you come down around here and then you go up, and away, probably to these highs. But if you top out just before here, which we did, you then have conditionally a higher likelihood of coming down here if your high is here. So if your high is up here, you on a conditional probability, you're putting a higher likelihood of ending up at this bump in the histogram. That's a bit further down. So that's why I did this trade, right? That's the whole point here. I was just showing, hey, I actually flipped. I got out of my dollar CAD short, my dollar CAD sell. I made 200 pips on it. And then I saw this opportunity and I decided to go long. And I really thought I was going to have to wait until after FOMC to even put on my first initial position. But I saw this and I'm like, okay, it's time to put on my 20 basis points position size on dollar CAD. And if you guys aren't familiar with how I do my position sizing, I do a 20, 30, 50 basis point position sizing. I'll try and keep my maximum exposure to any one asset at 1% of my account. And don't get me wrong, if you're using there's a few other positioning styles, but when it comes down to what I'm doing, when it comes down to discretionary trading and not getting surprised and hurt by sudden volatile events immediately after entering a trade, I find that my style is an improvement over what is most frequently communicated out there for risk management as far as position sizing goes. Because a lot of people say, oh, you should do Kelly Criterion. But when you need to enter a trade right now, going to a Kelly Criterion calculation website and plugging in all the information, by the time you spend the 2 or 3 minutes, the trade could be gone. And those situations do happen where the trading opportunity is right there in your face, and then it's gone 2 minutes later. So it's important to have some default size, to say the least. And in my trading, that has helped me out significantly. And by restricting it by default size, my first initial position size, to a relatively small amount, 20 basis points, like that's 1/5%, right? That's because of volatility. If I'm about to take a risky trade, and by risky I mean either I'm anticipating some volatility to occur in the near future or is occurring right now, if the volatility wipes me out and goes against me, I want to lose as little as possible. But if the volatility then goes in my favor, that 20 basis points of position size can suddenly turn into a 0.5% return, which on a lot of volatility is actually not that crazy of an idea. And for a personal account, 20 basis points sounds just fine. And it seems a little bit more rational to maybe some professional traders who might be listening in on this. 20 basis points sounds a lot more rational when you're trading a bunch of different assets as your baseline position size than to say, oh, I'm going to put on a full percentage point of my account on this trade. You lose 2 or 3 trades on a full percent, and you're feeling the hurt. Um, it's far more likely that someone becomes successful in trading when they actually understand the strategies that they're using and why they're using them and the assumptions behind them. And position sizing is part of that strategy. And so I'm walking you through the assumptions of why I'm selecting very specific position sizes. But if you listen to somebody else and they tell you they're using a 1% position size, but they don't tell you much about how to manage effectively the math of, oh, what happens if you lose 3-4 trades in a row on that size? You get screwed pretty hard, right? That turns into 3-4-5% loss real fast. Like, be careful when you listen to your favorite guru. I have some friends in the YouTube trading space that I trust and I listen to, and that's how most of you guys have found me. So whoever you know is my friend or my friends like Ivan, just keep listening to them, keep watching them. They're good guys, and I feed them all of my magic stuff. I feed them all of like, oh, here's all my cool new trading tactics and stuff. I give them that information. Whether they use it or not, it depends, right? Sometimes it's like, oh, this actually is a really applicable situation which you're in, and other times it's like, okay, now it's like my time, because there's a lot of things Ivan knows, and he specializes a lot with the pivots, right? I'm playing around with my fancy tools, and sometimes having someone who can, relate with a larger, wider audience helps so significantly more, because I'm going super in depth into some macro topics, into some statistical topics, and sometimes people just want to watch someone look at a chart, right? And go through trade plans like bam, 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 bam. Don't get me wrong, I do that in my trade group, but it's during streams like this I'd like to use them for educational purposes, not just on my indicators, but just on general trading rules and general trading practices that I've used to help me get to where I am today. And that have led me, the assumptions I've used that have led me to seek out the knowledge to build these specific types of indicators. Like, why am I using these things instead of TA or FA or whatever? And then why am I pushing all these outlooks, right? Why do I like self-determination theory stuff? I was actually just listening to a guy, a quant who's been trading for 30 years. I was listening to him on YouTube, and he runs one of the largest groups that sells courses on how to become a quantitative trader for equity options and how to code equity option strategies and automate them. He's one of the biggest course creators on it. And he did a video saying these exact words. And I talked about this literally in my last stream. You don't want confidence in trading, because confidence can be pride, the sin of pride. And I know this is Pride Month, but I'm literally talking about like the biblical pride, not the pride as we know it today, right? That's kind of a weird road, right? There's the biblical pride, and then there's just being pride in who you are, right? The definitions got quite mixed, right? So understand what version of the word I'm using, right? I'm saying confidence, overconfidence is probably a better way to put it. That type of pride and overconfidence about the particular trade plan that you have, overestimation of the knowledge you have, not having a sort of beginner's mindset, right? That sort of pridefulness, that sort of overconfidence, that sort of just in general, would just be called, confidence in trading, is gonna get you run over by a steamroller. Because generally speaking, what you don't see from super professional traders, they don't really have confidence, this airy fairy confidence. A lot of traders aren't like beaming out with this charismatic confidence that their trade plan is going to work and that the markets will follow exactly what they're doing. A lot of professional traders, when they're discussing a trade plan with you, will just tell it to you flat and stone cold what they think is going to happen. And that's a little different than exerting confidence, a character trait, pride, that sort of stuff, overconfidence. What you'll see, and what this quant who's been trading for 30 years thinks too, is you don't want confidence, you want conviction. And then guess what? When I was reading that article on George Soros passing his billions to Alex Soros, you want to know what was mentioned in there? Conveniently, this exact topic. That Alex Soros has conviction in his beliefs. It's not a confidence thing, because there's all these stories about how he's kind of a timid guy in boardroom meetings. It's his conviction and passion, right? Passion to do better at his business, and the conviction of his beliefs that got George Soros to believe that Alex Soros could actually take over for him. And it's the same thing that this quant trader thought about trading, and the same thing that I think about trading after reading about all this self-determination theory stuff. If you try to exude this prideful overconfidence, instead of having true conviction through competence, I like that saying. If you don't have true conviction through competence, you'll end up overconfident. And if price moves against you, you won't have the conviction. You won't be able to change your convictions. You won't be able to change your beliefs. Another thing, if you're interested in going down this idea more, is this idea of a Bayesian. So in statistics, there are generally two ways of viewing statistics. There's the frequentist and there's the Bayesian. And believe it or not, I have a Bayesian and a frequentist interpretation, statistic indicators for these charts. Pivot probabilities is a frequentist approach, and range probabilities is a Bayesian approach. And if you want to explore maybe the idea of having convictions, and then the idea of also how to be nimble, right? How it's kind of a paradox, right? How do you have convictions and beliefs and then be nimble in trading? The truth is that it's really not a paradox. It's about having kind of clauses on your convictions, right? It's about having exit strategies on your convictions, understanding what you actually think and are convicted of well enough to know when you should no longer be convicted to those things. And that's what being nimble is, and that's what you learn as a Bayesian. And there's a particular woman who I think still works at Google, who's done these fantastic talks about how to be thinking like a Bayesian statistician. She goes over all the history of the comparing frequentist and Bayesian approaches, and then typical fallacies when it comes down to Bayesian interpretations. I forgot her name, but if you search up Google and Bayesian or TED Talk, those three terms, I bet she would be the first result, or within the first 10 or 5. Now, I get I've maybe done one trade plan for the day ahead, and now I've been streaming for an hour and 25 minutes on my chart, but it says an hour and 10 here on the live stream. I tried to make the promise to myself that these streams would be about 30 minutes. Oh, boo hoo, poor Joe, right? Well, the truth is simply I'm going to try and make these educational. Sometimes I'll just want to get down to doing some trade plans, and sometimes I'm going to want to preach. Guess what? Sundays are days where I'm going to try and give a little back into the world. And it's also the days when I have all of the outlooks fresh in my mind. So I can kind of go on these tirades if I want to go down talking about macro, and actually making these trade plans is a lot easier after you read all those outlooks because you have then all that information ready and at hand to help bias you in a positive way. So long those expectations are met. But the good part is that I've been trading for so long that I have my own expectations, right? I showed you, right? What is it, Joe's FOMC hawkish expectations, right? And I had my list of things. I was like, this could go wrong, and the Fed could interpret this thing and that geopolitical thing that would make them more hawkish compared to what the consensus thinks right now. It's important that when you do start reading outlooks that you do try and think about things that aren't getting discussed. Like, oh, what would happen if the opposite occurred? And then doing your own research, just a couple of Google searches. And if nothing comes up on Google searches, you talk to other traders about it, right? Literally, one of the easiest ways to strengthen your thinking muscle in trading and figuring out what are good quality trading expectations is to talk with people, other traders specifically, about the opposite of the consensus view. What would cause the opposite of the consensus view to occur? So the consensus view right now is for a skip, maybe a hawkish skip from the Fed. Well, what would cause the Fed to be more dovish? What would cause the Fed to be even more hawkish and hike? And talk, right? Talk with people about what would create those sort of situations who have also been reading outlooks. So please continue reading outlooks, join the Discord, hop into the research channels, share your own thoughts, start talking, relating with the other traders in there. And let's get the Discord going. Let's get that Discord chugging along. And you only need one or two people to start having a chat before you start seeing other people looking at it and start thinking. Because the truth is you need kind of a, when it comes down to trading expectations, the more people you have involved generally, the better you can kind of anticipate, okay, about 20% of people think this is going to happen, and here's why they think that's going to happen. 50% of people think event B is going to happen, and here's why they think that's going to happen. Truthfully, the most valuable thing that could come out of the plan, the profit community here, and this is all free, is more people read trade research that's already freely available, and they start discussing it more widely and doing investigations into why people hold those views. What's the data that backs up those views, or the data that's against those views, so we can clearly identify risks to specific views, the consensus view, the pros and the cons against consensus, and the anti-consensus, for lack of a better word. Now, my expectation is quite clear. I am a bull on dollar CAD. I bought this thing. But just looking at this, I want to see a bit of down. Not only because I'd love to, you know, buy some more. Not only would I like to buy some more, right? Let me timestamp this with the current date. But I should probably check out how the yield spreads did. If the yield spreads got more positive here. Yeah. If today is a bullish day on dollar CAD in favor of the US dollar, I would be anticipating the top for the day to come in. Actually, yeah, somewhere around 133.65, 133.75, kind of in this range right here. I'll box it up. I'll box it up real quick, and I'll put in my little what I just said. It's always important that when you see someone make forecasts, that they actually put something at least on their chart. So then it's there for future reference. So it's like, oh, I said we were going to go up, up, or down, down. And then they don't remember that's what they actually said or not. Drawings are there to try and remind us of what we were thinking. And even if the path to which we get there isn't exactly what we thought, the net result over time is ultimately what matters. Don't get me wrong. If you're anticipating and making trade plans like this, which is we're going down right now and then going up, it doesn't matter if you effectively go sideways the rest of this day and then up. You're still wrong on today because your expectation was down now and then up in like 6 to 12 hours from now. Not sideways for the rest of today and then up tomorrow, right? So if someone's coming out with a specific forecast and they're trying to do timing stuff, there is a bit of leeway you can give there with how wrong they were, and that's pretty much a subjective thing. Some people are pretty black and white about it, like, oh, it didn't exactly go to this low or this high, and it didn't move at exactly the times that you thought it was going to move. Okay, that's maybe a bit too precise, right? When you're doing discretionary trade plans like this, I'm not a robot. I'm making best guess based off the information that I have. But in general, if someone's like wildly off, or they're mixing up, the big problem that I want to just highlight here is when traders make forecasts for price targets and then they include like, oh, one second, I gotta sneeze. When they mix up their time frames, and by like when they expect timing wise for price to hit a target. So I don't really have a timing target here. I'm saying, I'd like it to come down and then like it to come up. The thing could just go up and then come down. Either way, I'm fine. I'm not trying to time it. Although it would be so nice, right? My preference would be it follows these arrows. My net expectation at minimum is just, oh, it comes up to roughly this price, where maybe I'll try and sell a little bit of what I got and then try and buy a low the following day. So then I can take whatever little bit of extra money I make up here and I'm able to put it in also as a better position down here. That's totally an option that I could exercise. Right? I don't think I'd actually do that because I have longer term expectations. And speaking of longer term expectations, I want to check out the yield spreads on dollar. Oh, they got more bullish. They got more bullish. Look at the short term yield spreads. They're all green. Oh, man. Short term yield spreads are all green. All right. That's kind of the first sign that this bullish trade plan from yesterday is going to work out. Man, oh man, wouldn't it be crazy if I nabbed the low? I have another chart that I use, another chart layout with all of my trade plans for the trading group, and that I use more proactively. This is my chart for the streams specifically. But man, I have so many arrows on my other chart saying, want to buy in this area, want to buy in this area. And here I was thinking I wasn't going to be able to get the entry. And here's like, oh, there's an opportunity here. They take the opportunity. And it comes in right when a macroeconomic event comes in, right where the the range probability low comes in for the day, right when the yield spreads start moving in favor of the dollar CAD. Also, it's at a monthly probability weighted pivot low for the whole month. So I have more than enough reason to continue anticipating price appreciation here on dollar CAD. However, just because I have that information doesn't mean that CPI or the FOMC won't crush my hopes and dreams here. So that's what I mean by, again, if you're not reading outlooks, that information's not really on the chart. And for all intents and purposes, these indications and these indicators I have, while they're on the chart, unless you're in the trade group and you have these indicators, join the trade group, right? Link in the description. Just go to the WAP store, get the trade group, you get one-on-ones with me, you get access to all my indicators. That's $100 a month. Like, you don't get these things on your chart by default. And just because it's on your chart doesn't mean you don't need to try and understand why things are changing, why things are moving the way that they're moving. If there's one more thing I can say when it comes down to actual pivots in price, ebbs and flows, peaks and bottoms, right? Tops and bottoms, is that there are clear reasons for changes in trend. Why those things change. And they're usually based off trading expectations. And the better you are at anticipating the change in trading expectations, generally speaking, the more professional you will be, and the more likely you will get to picking these lows. But it takes a lot of work and a lot of dedication to read all these outlooks. I mean, it takes about 2 hours to learn how to use all these fancy schmancy indicators that I make. Literally, charts are the least time intensive thing. Just flat out. When you have a strategy, it's just, okay, what do I do with the strategy? When you have the indicators, it's just, okay, how do I interpret the indicator? When you have risk management, it's like, okay, what are the rules of the risk management? But when it comes down to reading outlooks, you have to spend all this time thoroughly reading and making sure you actually comprehend the reasons why people are making the decisions that they're making. And that's the missing part for most people. So, hopefully you guys are taking that message to heart and joining the Discord and reading the outlooks. It's all free. All this stuff is free. Just, all the outlooks are free. But if you want the one-on-one help of going through the outlooks, then yeah, that's my time. That's like a bit of tutoring. But then you get outlooks, right? No, you get all the indicators, right? You get the trading group, you get all the trade plans, right? Good stuff. So that's one trade plan. Maybe I can do something else. Maybe I can do something else for you guys who've been watching me now for a solid hour and 24 minutes. How about also Eurodollar? I have a particular affinity for trying to short euro dollar here, but I don't think I'm going to get it. I really, really wanted to short euro dollar this week somewhere around 108, but I don't think I'm going to be getting it. I don't. I just think the euro is going to be too weak. And you can just see from these distributions, oh, the low's probably going to be around 107.3, and the top's probably most conservatively going to be around 107.6 or 107.7. And then check out the pivots and see how the pivots kind of line up where the histograms kind of drop off. You can see how most of your lows for a given trading day here on euro dollar occur between S1 and S1.5. That probably will make you more bearish on the day-to-day trades. And the good part is that this information changes from asset to asset to asset, because every asset has its own unique distribution. So your interpretation is going to be the same. How you look and view these indicators are going to be exactly the same, but you're going to come to different conclusions, like, oh, I need to shift my view a bit lower. Oh, I need to shift my view a bit higher. Sure, I'll do pound dollar for you, Prinsley. I'll absolutely do it for you. Let's see. Let's look at pound dollar for the day. Oh, wow. We had this spike lower. And this is a weird shape. Maybe I need to load more data. I wonder why there's just such, a skew right here and right here. I don't know. Let's load more data. I mean, that kind of resolves it. Oh, wow. It's got quite a skew to the upside, huh? Well, I can say one thing. 66 to 70% of your tops for the trading day occur below the R2 pivot. And that's not really saying a whole lot. That's like an ultra conservative and somewhat obvious expectation that your top for the day would come in below that R2 daily pivot. But to make a more aggressive forecast, I could say, well, if you're anticipating more upside, then the top for the day is probably around 1.2605, somewhere just above this R1 pivot. But I don't know, I'd say just anywhere below R1.5 you can easily top out. It's not so easy to actually say exactly where you're going to top out other than just saying your best shot's probably this R1 pivot. Now down here, this is also kind of interesting. If I hide this real quick for clarity, a lot of your lows occur right around this area here. And we're already down here because this very first bar spiked lower on the first hour. So, sure, we could go lower, but if I was a bull, I wouldn't anticipate us going any lower today than S1.5. I wouldn't anticipate us to go past S0.5. But once we go past, you can see like right here, the odds say 50% of your lows are above this line and 50% of your lows are below this price. So yeah, if I was a bull, I'd anticipate my low to come in somewhere around the central pivot today, which we're currently at, right? Technically, your low could be in right now, but I don't know exactly how likely that is. I'm not trading pound dollar all that much. But if you are frequently trading it, hopefully you have some better expectations. However, once you go past this S0.5 pivot, I'd start to be careful because now you're starting to deal with a sort of falling knife odds situation where you have odds that are evenly distributed all the way from this S0.5 pivot point down to S2. and it becomes very hard to predict exactly where your low is going to come in. So at that point, you want price action to come in and maybe a bit of an actual reversal. Maybe some data comes in or something comes down the financial juice news feed. That would be positive for the pound. Yeah, so I would be careful trying to go long in this area right here because the odds are flat. And when you have a flat histogram, it it can result in quite a bit of uncertainty, to say the least. So the more peak you have in your histogram on this indicator, the more certainty generally you can attribute to it. Okay. Well, I think that's going to be that for today. Because now we've been going for an hour and 30. And I'm sure you guys are going to have more than enough content maybe to rewatch this one or two more times. Because this was a particularly great stream. I had actually quite a good amount of energy for this stream. Thank you guys for all the support you give with these streams and listening to me go on and on about my macros and my indicators and my trade analysis. I hope it's helpful. I hope it's educational for you guys. And again, if you want to interact with me and other people who want to follow some of the things that I preach, join the Plan the Profit Discord and start talking about the things that you're anticipating, what your trade expectations are, some of the things that you're looking at. And if you have my charts, you already have my indicators, feel free to post them in the trading chats or in the group chats for whatever you're looking at. Thank you guys for watching. Here, and I'll go ahead and say that like this. Thank you guys for watching. It's a big deal. Also, the last video that I put out, it was the most watched and the most liked video. And it was also about, call it 45, 50 minutes. So I wonder how this longer video is going to do. So if you've watched this far now all the way up to the end, just a little bit of a reminder, like, subscribe, all the good stuff. Yeah. Boom. I'll see you guys in